So when we talk about financial analysis, there are a lot of time you apply the basic concepts, time value of money, risk and return trade-off. I can give you an example of how to apply those concepts in financial decision making. One of them is the so-called financial leverage. So leverage, some of you may recall in high school physics, you learn about using leverage. That means, like you can see, in order to move or lift a heavy object, you use a lever or a stick. If you set it properly, a regular person may be able to set up the lever using leverage to move that big rock or boulder. So the concept of using leverage basically is to use relatively small force to move a heavy object. That's the concept in physics. But if you apply that to financial decision making, basically it's trying to use small amount of money to make large amount of money, or small amount of investment to generate large return. So what does that mean using financial leverage? We usually mean using someone else's money, using borrowed money to finance at least a portion of your investment. So using financial leverage, using someone else's money, when you borrow money to finance a portion of your real estate investment, what's the implication? First of all, if you borrow money from a lender to pay for your real estate investment, then you don't have to come up with as much of your own money. So that is the first effect. Reduce the capital requirement. Using home purchase as an example, if you're interested in buying a $100,000 condo, okay, if you don't use leverage, that means you don't borrow money from anyone else, you need to have $100,000. But in the real estate market, in residential real estate, very often you can borrow money from a bank for 80% of the purchase price. So in that case, you borrow 80% or $80,000, you only need to have saved $20,000. So that substantially reduced the capital requirement. That's the first effect. But with that, there are also two additional potential effects that you need to better understand. First, when you have used financial leverage, your rate of return may be affected. Actually, this is a positive impact because if you think about the numbers I just mentioned, $100,000 home, you put in $20,000 of your own money, $80,000 of borrowed money. Let's say a year later, the value of the house has increased. Great, increased by 10%. Now it's $110,000. That's the value of your house. How much do you owe the lender? By the way, the lender doesn't have a right to share that appreciation additional $10,000 with you, so you still owe $80,000. The house is worth $110,000, you owe $80,000. So how much is the equity? Equity, which is your own share. $110,000 minus $80,000. Now your equity or your own money in the house, it's not cash, you cannot spend it yet, but it's your money. Now it is $30,000. You put in $20,000, now you have $30,000. From 20 to 30, that's a 50% increase within a year. How much is the appreciation in the house, the value of the house? 10%. What is the increase in your equity value? 50%. How do you like that? Pretty good, right? So that is the benefit of using financial leverage. However, there's no free lunch. You owe $80,000 to the lender. What if the value of the house drops? If the value of the house dropped to $90,000, so it's a 10% decrease from $100,000 to $90,000. 10% decrease, how much do you still owe? Still $80,000. So $90,000 home value, $80,000 mortgage you still owe. Now the money you have in the house dropped from $20,000 to only $10,000. All of a sudden, you lose half of your investment. Your down payment has a 50% decrease. So that is the double-edged sword, because using financial leverage on the one hand can enhance your return when things go well. But on the other hand, it may increase your loss when things go bad. So the trade-off here is using financial leverage increase the potential return, but it will also increase the risk involved in your investment. That risk and return reward, that trade-off is reflected in this situation. So let's think about using debt, because financial leverage, that means borrow money to finance your investment. So in real estate, when we borrow money, what kind of loan do we borrow? We borrow mortgage loan, right? Because mortgage uses real estate as collateral. And let's continue to use residential as an example, just to help you understand the concept of mortgage financing and how that is related to financial leverage. Think about a mortgage, a loan. When you borrow money from a lender, what features or factors do you need to understand? Do you need to negotiate with a lender? First of all, the simple factor, very simple, basic factor is how much money do you need to borrow, right? So the loan amount is very important. So how much money you can borrow, that also means how much money you have to pay back. But the lender is making an investment, so the lender will charge you interest rate. The lender will consider your FICO score, what type of loan you're borrowing, and what's your income. The lender consider all those factors to determine how much interest rate the lender is going to charge you. So the loan amount is important, and the lender will determine the interest rate. The loan amount is the principal you have to pay back. Interest rate multiplied by the loan amount will be the interest payment you have to make periodically. That will be the profit for the lender. But also, the two parties, you and the lender, needs to determine how soon the loan has to be paid off. You may borrow a 10-year loan. You may borrow a 15-year loan. You may borrow a 30-year loan. In the U.S. residential mortgage market, the most typical, most common term in terms of the length of time is 30 years. That means as a borrower, you borrow $500,000, you pay interest periodically, but by the end of year 30, you have to pay off the loan. So loan amount, interest rate, and we call it time to maturity or term to maturity. Those are some of the basic features of a loan. But in addition to that, because sometimes if you think about, okay, a loan, if you borrow $100, interest rate 1%, you pay interest $1 each year. $100 times 1% interest. But the question is, when do you have to pay back the principal? If you have a 10-year loan, do you wait until the end of year 10 to pay back the full amount of principal? Or do you have to pay back a portion of the principal every year over the 10-year period? That is the so-called amortization, and that is one of the features in a mortgage loan. Because in the U.S., typical residential mortgages, 30-year mortgage, payments are made on monthly basis. So over the entire life of the loan, the borrower will make up to 360 monthly payments. And every month when the payment is made, the borrower will pay a portion, will pay some interest because you continue to get charged interest, but you will also repay a small portion of the principal you borrow. So instead of waiting until the end of year 30 to get all the principal back at once, the lender will ask you to repay a portion of the principal every period. And that gradual repayment of principal is called amortization. So you may have heard of the term interest only. So with a loan that is being amortized over time, every month the borrower pays interest and small portion of principal. But if you have an interest only loan, then periodically you only pay interest. That also means you do not repay principal over time. When will the principal be repaid? sooner or later, with an interest-only loan, it will be repaid at maturity. The full amount has to be repaid at once. So those are the typical features of a mortgage. So a mortgage has an interest rate, but in the mortgage market in the US, most of the loans have the so-called fixed rate. So if you have a 30-year mortgage and the lender tells you at the beginning the interest rate is 4.5%, then you get charged 4.5% a year. Each year over the 30-year period, the interest rate doesn't change. But certain loans actually have an interest rate that may change over time. In this context, we call that adjustable rate mortgage, ARM, or sometimes people talk about ARMs. So in mortgage industry, when people talk about ARMs, that means adjustable rate mortgages. That means the interest rate on the loan may change, will be adjusted periodically. So the interest rate could go up, the interest rate could go down. One thing to understand is that the interest rate doesn't need to be renegotiated periodically. The lender and the borrower, once they agree on the terms of the loan, they will continue this formula that the interest rate will be calculated. So the lender and the borrower doesn't need to meet every year to renegotiate, okay, what will be my interest rate next year? Instead, a formula has been agreed on, and based on the market conditions, the interest rate will be determined periodically. But if you have an adjustable rate mortgage, that means your mortgage payment could change next year, 2 years from now, 3 years from now. So the borrower needs to understand the difference between a fixed rate mortgage and an adjustable rate mortgage. So if you're interested in buying a house and you need a mortgage, where do you get the money? You can go to the internet and search for do your research, find the lender that offers you the best deal. So a lot of times the lenders will give you interest rate quotes and then tells you how much the mortgage monthly payment is. Of course, you provide some information, the location of the property, your credit, maybe the value of the property and how much you want to borrow, because those are all the risk factors the lender will have to take into account. And then the lender will tell you, okay, maybe if you want to borrow this much money, this is the interest rate. And on the website, the lender will also tell you if you have the loan amount, the type of mortgage, the interest rate, the lender will tell you the monthly payment. How is the monthly payment connected or how to those different mortgage terms? Because earlier, if you think about the basic features of a mortgage, loan amount, interest rate, and the term to maturity related to how the principal will be repaid. So those are the key factors. Those will drive the mortgage payment, because how the mortgage payment is calculated is based on the risk return reward, and also it's a direct application of time value of money. Because if you think about this, to complete a loan transaction, you need to have two parties, the lender and the borrower. The lender gives borrower the loan amount upfront. In return, the lender will receive the monthly payment over the next 30 years. So let's use the most common type of mortgage, 30-year fixed rate mortgages. So a fixed rate mortgage, 30-year term, that means the borrower will make monthly payments over the next 30 years, 360 equal monthly payments. So the lender gives the money upfront and expect to receive monthly payment every month back from the borrower. So the two parties, let's assume both are rational. They both want to pay less than they get, because the lender wants the future monthly payments to have a higher value than the loan amount he or she has to give to the borrower. On the other hand, the borrower wants to get more money, the loan amount upfront, than the value of the future monthly payment he has to pay back to the lender. So if you think about the cash flow pattern, one is loan amount upfront, The other cash flow stream is a 30-year monthly payments, 300 equal monthly payments. They occur at different points in time, but if you apply time value of money, you can actually estimate the present value of the 360 equal monthly payments and try to compare the present value of monthly payments with the loan amount. From the lender's point of view, the lender wants the value of future payments to be greater than the loan amount because, again, you want to get more than you pay. The borrower, on the other hand, wants the loan amount to be worth more than the value of future payments. How can they agree on the transaction if they just have the opposite perspective? The only conditions under which they can agree on the loan is when the loan amount and the future monthly payments when they have the same value. So the borrower doesn't lose money, the lender doesn't take advantage of the borrower. So the mathematical condition and the rationale behind the mortgage monthly payment calculation is that the present value of your future equal monthly payment has to be equal to the loan amount that is received from the lender. So that is the foundation of the mortgage calculation. You can see mathematically the equation may be intimidating, but the rationale should be pretty straightforward. And if you understand how to take advantage of Excel, understanding Excel modeling, the calculation becomes very, very straightforward.